Well, good afternoon, ladies and gentlemen. Welcome to the ESRI Policy Forum today. My name is Yutaka Murayama, head of Economic Social Research Institute of Cabinet Office. Today, we have Professor Barry Eichengreen from University of California, Berkeley, as presenter on my right side. And we are going to discuss about public debt and its management issue. As we all know, Professor Eichengreen has been contributing so much, especially in the domain of international macroeconomics, from the perspectives of theory, empirics, and history. 3 years ago, he publicized a book entitled In Defense of Public Debt. It focuses on public debt issuance, whose origin goes all the way back to the medieval era. The volume draws some lessons for the better functioning of the borrowing, for better national policy outcome, as well as for avoiding consequential economic malfunctioning. This is quite timely, as many countries, including Japan and the US, have adopted sizable pandemic-related relief packages backed partly by public debt issuance. Also today, we have Ms. Mana Nakazura as a commentator on my far right. She is a leading analyst on the credit market on the private side of the economy. On the public, she is a member of the government's Economic and Fiscal Policy Council, which consists of 4 members as well as 6 cabinet ministers. The Council plays a pivotal role between fiscal discipline and growth-enhancing policies. Well, without further ado, I might proceed. I would like to have a presentation from Professor Eichengreen about recent topics around public debt insurance management and related issues. Now, Professor, please.
So Yutaka very kindly mentioned the book that I am shamelessly advertising this afternoon, In Defense of Public Debt. And you inquired as well about my having worked on exchange rates and capital flows and such issues in the past, what impelled me to look at the history of public debt. And the answer to that is partly the International Monetary Fund, which had a conference on sovereign debt in 2019. And my co-authors and I had so much fun working on that paper that we expanded the paper into a history of public debt that actually goes back further than the medieval period, all the way back to the ancient Greeks and Romans. You can kind of get a sense of the argument of the book from the cover, that when you have an all-hands-on-board emergency, when the castle is being attacked, the government has to mobilize all the resources it can, including by borrowing. When there are productive infrastructure investments on offer, it may similarly make sense for the government to borrow. There has been a strand of thought in the United States and elsewhere that government borrowing is excessive and unproductive, and we wanted to look to some of the counterexamples, periods where government borrowing was essential for the survival of the state, be it wars, pandemics, natural disasters, or for that matter, economic development opportunities. So we developed that argument through 10 chapters, and then in chapter 11, we argued once the emergency has passed, it's necessary for to consolidate and for government to restore its ability to borrow in the future the next time a bad thing happens. And that was the view from 2020, 2021 when we wrote the book and when the book came out. And if you look at the view from 2024, you will be reminded that this consolidation has not taken place. There has been a little bit of a decline in debt to GDP ratios because of the surge of inflation that a number of countries have experienced. But whether you're talking about the world as a whole, low-income countries, emerging markets, advanced economies, the trend since over the last 15 years has been public debt ratios rising and showing very little tendency to come down. Indeed, sharp, sustained reductions in public debt are exceptional. We know this because of the previous slide that debt to GDP ratios have been trending upward across all these categories of economies. I think the argument of the book stands that governments have borrowed for good reasons, by and large, in response to financial crises, pandemics, wars, other emergencies, but only in rare instances have they succeeded in bringing those higher public debt ratios back down once the emergency has passed. And that is because of both economic and political factors. So slowing GDP growth and rising real interest rates, unfavorable R minus G in shorthand, make for adverse debt dynamics. We're now in a higher interest rate environment owing in part to those higher inherited debt ratios. And if you believe the forecasts of the IMF and the World Bank for the world as a whole, they forecast slower global growth going forward. So both elements of R minus G are moving in an unfavorable direction from the point of view of debt dynamics. Similarly, on the political front, ideological polarization and frequent government turnover make it hard for those seeking to bring down high debt ratios to stay the course. Polarization makes it hard to agree on how to share the burden of fiscal adjustment, fraying the coalition favoring debt reduction, causing policies to be reversed, and turnover creates opportunities for a new administration to repudiate the policies of its predecessor, disrupting efforts to sustain substantial primary budget surpluses. So having written this book, I was asked a year ago by the Kansas City Fed to write a paper on high public debt for the Jackson Hole conference. And with IMF co-author, we looked at instances where governments were in fact able to sustain debt reductions over time, and we found only two robust correlates of large debt reductions: robust economic growth and low levels of political polarization. So previous observation that economic growth globally is likely to be slower going forward than it has been in the recent past, and in many places, not evidently including this country, I'll come back to that, political polarization has been on the rise as well. So that's not doesn't make for an optimistic forecast of the scope for debt reduction. So let me talk in a little more detail now about prospects for debt dynamics in the United States and Japan. So here are the headline figures. For this figure, as for all the others, keep your eye on the vertical axis, which is very different across the panels and will similarly differ across some panels that I'll show you in a minute. So Japan is sometimes invoked in the United States as a source of reassurance. Japan's debt to GDP ratio is twice as high as that of the US, yet interest rates here are lower. The IMF annually does an Article 4 review of Japan, and as part of it, it conducts a debt sustainability analysis, and it concludes that Japan's debt is sustainable in the sense that it is likely to remain stable as a share of GDP over time, mainly due to favorable R minus G, in turn reflecting the assumption of continued negative real interest rates, continued low nominal interest rates, not as low today as yesterday, but low nominal interest rates, and the resumption of inflation. So we may want to talk about that IMF view of the prospects of Japan, for Japan as we go forward. Can the United States really take comfort in this? The IMF also does debt sustainability analyses for the US over this same horizon, and it shows, if you compare this figure, this fan chart with the previous one, it shows a slightly rising debt to GDP ratio for the United States over the next decade or so, rather than a slightly falling one, but not an alarming rise in the debt to GDP ratio. Again, even though the United States is running substantial primary budget deficits, it has a favorable R-G as well in the US case due to relatively robust forecasts for economic growth. The CBO, the Congressional Budget Office, looks out further than the IMF does. It's required to do that on the basis of current law, which, if I understand correctly, assumes that the tax cuts put in place by the Trump administration will expire in 2025. And I think we know whoever wins the presidential election later this year, the tax cuts will not be allowed to expire in their entirety. But even on the assumption that they expire and that additional revenue hole is not created, the forecasts look much gloomier as you go out into the 2030s and 2040s, reflecting adverse demographics and increased healthcare costs, pension costs, and so forth. Should we worry? After all, even the CBO forecast suggests that the United States will be less indebted than Japan is at the moment, and Japan is perfectly able to manage a debt to GDP ratio that resembles what you see in this CBO forecast. Point being that not everything else is equal across the two economies. For one thing, banks and insurers are more important in Japan's bank-based financial system than in the market-based financial system in the United States. You can see here that the assets of banks and insurers as a share of GDP are on the order of 150% in the United States, but 500% in Japan. And banks and insurers maintain sizable holdings of government debt for regulatory and financial. Alan and I were talking about this on the way over, and maybe for other reasons as well. You can see that quite striking difference in the figure on the right, and it's important to observe that as the JGB holdings of depository institutions and insurers in Japan have declined in the last decade or so. Those of the BOJ have risen to basically take up that slack. Then there's the distinction, of course, between gross debt and net debt. Japanese consolidated public sector holds financial assets of about 60% of GDP, both equities and foreign bonds, foreign equities. By comparison, the US federal government holds financial assets equal to only to 14% of GDP, and the US federal government's holdings are in the form of bonds, not in the form of equities, so the return on them is lower as well. So net debts differ rather less across the two countries than the headline gross debt figures would suggest. Then there's the fact that domestic savings are higher in Japan. Since 1980, Japan has persistently run a current account surplus, more than fully funding its debt at home. The US, of course, runs current account deficits, meaning that it funds its investment and debt partly abroad. And the figure on the top, where the gray part is domestic central bank, is again a reminder that the BOJ figures more importantly in the market for JGBs than the Fed does in the market for U.S. Treasuries. So historically, the United States hasn't found it difficult to fund its debt abroad. U.S. Treasuries have been regarded as the ultimate safe asset. They are the bedrock of foreign central bank portfolios. They're the bedrock of corporate treasurers' portfolios as well. That's the so-called exorbitant privilege that the United States and the U.S. Treasury bond enjoy. But the question is whether this will continue to be the case indefinitely going forward. There's a lot of talk about the possibility that we might be looking at the end of dollar dominance with U.S. recourse to financial sanctions, U.S. weaponization of the dollar, if you will. Is this likely to be a fact of the past rather than of the future? So if you look under the lamppost, we have the best data on the role of the dollar as a reserve currency. You do indeed see a downward trend over time. So the dollar's share of international reserves has been declining over the last quarter of a century by about 1/2 of 1 percentage point a year, from slightly above 70% of total allocated or identified foreign exchange reserves globally to slightly less than 60%. The data that we have on currency invoicing and the use of currency in currencies and payments suggests less of a decline, but these different functions tend to move together over the longer run. So who has been taking up the slack from the dollar? Not the euro. So the euro is the dark blue line here, and you can see, contrary to the hopes and expectations of European policymakers, the euro has not become more important as a reserve and international currency, and the same is true on other dimensions that I don't show you here, the euro's share of international bonds, the euro's share in invoicing, and so forth. Not the Chinese renminbi. So this is the best effort of myself and my co-authors to reconstruct the currency composition of foreign exchange reserves globally. About 80 economies, 80 central banks now publish data on this. The Russia's central bank published data on it, on the currency composition of its reserves up through the end of 2021. So you can get a reasonable picture of this, and the brown slice of the pie is the Chinese renminbi here, which is about 2% of the total. And the big blue slice is, of course, the dollar share of the total. The renminbi has stopped gaining ground as a reserve currency as well since sometime in 2022 or 2023. So what is going on here in a very small nutshell? The euro is held back by a shortage of safe and liquid investment-grade AAA rated public label safe assets. Last time I looked, there were only 4 euro area countries with AAA ratings, and many of their bonds have to be held by Europe's own banks as capital and reserves, or have been absorbed by the European Central Bank as in the course of quantitative easing and all that. The renminbi's role is held back by the fact that China maintains capital controls of various sorts. And I think some reserve managers are reluctant to park their reserves in Shanghai because of the absence of checks and balances on arbitrary action by the Chinese Politburo. So when I went to China before the pandemic, I would say every true international currency in history has been the currency of a political democracy or republic. And my Chinese audience would respectfully nod, and I would go on. What has happened, I think, which I didn't anticipate when I was writing on this like 15 years ago, is digital technology and new trading platforms, that it has become easier to buy, sell, and hold the currencies of other smaller economies, small, open, well-managed economies. So the share of international reserves that the dollar has lost has been gained by that the US dollar has lost, has been gained by the Australian dollar, the New Zealand dollar, the Canadian dollar. Why these are all named dollar, I'm not sure. If they're not named dollar, they're named krona, the Chinese, the Swedish krona, the Danish krona, the Norwegian krona, also the South Korean won. But currencies of smaller, well-managed open economies seem to be the targets for reserve managers who want to diversify away from the US dollar. So here is another set of figures where, especially on the bottom, I would caution you to beware the gap, beware the vertical axes. So you can see from the top figure that China now settles half of its own trade using its own currency. It settles as much of its exports and imports using the renminbi as it does using the US dollar. But if you look at global trade finance, you can construct a figure like the one on the bottom that makes it look like the renminbi is gaining a lot of ground over the dollar. But its share in global trade financing is 5%, where the dollar share is like 85%. Mind the gap. Here you can see once again that post-US sanctions on Russia, or post-Western sanctions on Russia, there has been some additional use of the Chinese renminbi in trade-related payments. So if you look at data for SWIFT, you can distinguish purely financial transactions from transactions associated with trade, and you can see some pickup in renminbi-denominated trade-related payments, but again, from a very low level compared to the share accounted for by the dollar. And if you go to those same central bank reports and ask who holds Chinese renminbi as reserves, the answer to a first approximation is Russia. Not surprisingly, that's the blue part of the pie. When we did this for the end of 2021, which was the last time we had actual Russian data, there were some surprises here. Who knew that the Central Bank of Brazil was number 2? I wouldn't have guessed that. But the point still holds that other central banks hold only a small fraction of their reserves in renminbi, and it's Russia which has moved out of Western currencies, out of the yen, into the renminbi and into gold. So it's possible to extend the Russian data forward in time on the basis of other statements, and this figure is again a reminder that what the Central Bank of Russia has done is it's run down its dollar holdings ever since Crimea in 2014, and it's built up its renminbi reserves and its gold reserves. But I think that experience remains one of a kind. And I would argue that history suggests that Russia holding the renminbi as reserves is not surprising. More generally, there is abundant historical evidence of countries holding as reserves the currencies of other countries with which they are geopolitically aligned. So with a couple of co-authors, the bottom article on this cover page uses historical data to basically demonstrate the fact reserve managers respond to the need to finance trade flows, They're interested in relative yields, but they're also interested in the security of their reserve holdings and interested in holding the currencies of their geopolitical allies. As I said before, there's a lot of angst about the dollar's weaponization, and with a couple of co-authors, we looked at whether sanctions in the past have affected the reserve holding behavior of central banks. We found very little evidence to that effect. We found very little evidence of movement from the dollar to other currencies as a result of US sanctions, partly because also in the past, the United States has typically moved together with issuers of other reserve currencies when applying sanctions to countries that are human rights violators, et cetera. So that basically leaves country reserve managers contemplating the possibility of moving away from the dollar with few places to practically go. So rather than weaponization of the dollar, I worry more about the medium term. I worry more about growing foreign reluctance to hold US Treasury debt, because reflecting fears that a polarized political system in the United States is unable to agree on revenue increases or spending cuts. That's the earlier point about how fiscal consolidation is more difficult in the medium term and in a polarized political system. Foreigners may become increasingly fearful that the United States will inflate away the value of the debt. They may become more concerned about fiscal dominance. They may become even more concerned if there are political threats to the independence of the central bank. So I was interested to find this article from a recent issue of the Review of Economics and Statistics, where 3 economists tried to measure effective polarization, the extent to which citizens of a country feel more negatively toward other political parties than their own. And you can see here on the top that effective polarization has been rising notably over time in the United States, but has not been rising and remains relatively low in Japan. So I'm not going to pontificate on Japanese politics, but I'd be interested in hearing reactions to this. It is, to my mind, a warning about the difficulties we will face in sustaining debt consolidation in the United States, greater difficulties than are likely to be faced in Japan. And if I can indulge myself and cite one more book, the central idea of this book was that political polarization in the United States has deep historical roots which go back to our original sin, if you will, of slavery, racial division together with more than a century of tension over immigration, create a lack of social solidarity in the United States. The implicit comparison being with Japan, that make it hard for Americans to agree on the shared sacrifice needed to bring its debt, among other things, under control. So I have a superfluous slide, this one, with which to conclude.
Well, Barry, thanks very much indeed for your very insightful presentation. Now, Nakazura-san, I'd like to have your comments upon the presentation, please.
Thank you for your introduction, and thank you very much, Professor Eichengreen. Your presentation is very informative. And I think he feels very bad jet lag right now. But even though, thank you very much. And my name is Mana Nakazora from BNP Paribas Tokyo. I have been a credit analyst for a long, long time. And recently, over the last 5 or 6 years, I have been conducting ESG research. And also, I am a private member of Economic and Fiscal Policy Council. So that's why today, I think it is because of this relationship that I have been given today's heavy and important role as a discussant, to tell the truth. And first of all, I would like to thank everyone at ESRI, Esri, and others for giving me this valuable opportunity today. It is a great honor to hear directly from Professor Eichengreen. Professor Eichengreen doesn't need any introduction at all, as seen through the insights provided in his many books, including I pick up another book, Professor, Golden Fetters, The Gold Standard and the Great Depression from 1919 to 1939. Why I choose this book? Because I found this book on my shelves. However, I forgot to bring today. Really, I would like to get the sign on this titles. However, I forgot. And Professor Eichengreen is very knowledgeable about the economic situation everywhere in the world. Today, I sought his perspectives on In Defense of Public Debt, which primarily focuses on Japan and the United States and China. Sometimes he talks about the Russia and the Euro to be highly significant and sending us a wake-up call. His analysis clarifies the complex relationship between various countries and their short-term impacts, offering many insights that were very intriguing to hear. Particularly, the conclusions regarding the relationship between the Chinese yuan, renminbi, and the United States dollar were clear and convincing, providing a valuable learning experience. Yeah, to tell the truth, I am very embarrassed to speak in front of so many distinguished experts, but I would like to briefly discuss the current situation in Japan. Professor Eichengreen talked a lot about R and G relationships and the relationship between that. And I would also like to look at the same situation in Japan. So from here on, I would like you to take a look at my presentation materials. On page 2, you can see the relationship between R and G in Japan. The Bank of Japan's monetary policy meeting happened to be held today. The result was, as you may know, that interest rates were raised 0.25%, and the bank announced its intention to raise interest rates more and more, maybe, by significantly reducing the outstanding amount of government bond purchases. So to tell the truth, I would like to hear from Eichengreen, professor, about the thoughts on this decision by the Bank of Japan. However, I would like to first clarify that in terms of the relationship between R and G in Japan, interest rates will not rise too quickly, dramatically. And also, it may seem that further growth is unlikely. However, Japan aims to achieve a growth rate that is at least higher than interest rates are, particularly focusing on GX investment. Actually, look at this chart. I think you can see that the average growth rate. So average growth rate is these horizontal lines. Compared to interest rates is gradually increasing. So the situation is improving a lot. And please look at page 3. In the growth case scenario for Japan, one can see that Japan's debt situation is expected to improve gradually rather than worsen. So actually, these two charts is the left-hand side chart is the primary balance to GDP ratio, and the right-hand side chart is the public debt to GDP ratio. And the dot line is the estimation by the government. So of course, there are criticism that the baseline case is more realistic, and that the outlook in the growth case scenario is over-optimistic. Yeah. That's true. But if growth can be achieved consistently, as the Japanese government believes, there may be no need to worry too much about Japan's debt situation. However, even if we assume continued growth, should we feel safe, given Japan's outstanding debt problem is already serious enough? This page. You can see the ratio of public debt to GDP in the long-term situations. Japan's debt quality is poor, and the debt ratio has already diverging. In fact, this is already the second time that Japan's debt has been diverged. You can see that the reason why the divergence converged last time was the war. I hope that this time's divergence will end not as a result of war or earthquakes, but rather due to wisdom of the Japanese peoples, hopefully. If we are unable to do so, we will be maybe downgrade and concerned about our ratings. Page 5 is our rating situation. This is a list of major countries' ratings. And Japan's rating has fallen to a considerably low level, single A or something. And there are still concerns that it may reach triple B level. Lastly, from this perspective, I would like to ask Professor Eichengreen 2 questions. My first question is, despite being at a very precarious level, there is a judgment, as the IMF also predict, that the debt situation of both Japan and United States are sustainable. However, Japan's debt situation is such that my Italian friends question about why Italy is at triple B and why Japan is at single A. And I think my Italian colleagues' complaints are understandable. Because as you all know, Japan's various debt indicators are much worse than Italy's. So, Professor, I would like to hear your thoughts on what you think about Japan's debt problem and fiscal discipline, given the changes in interest rates and growth rates, and any advice you may have to Japanese government. And my second question is regarding the outlook for the United States. There are recurring implications concerning the potential risks in the US. While the outcome is uncertain, the new administration will face the debt ceiling deadline in January 2025. There are concerns about whether the new administration will be able to reach an agreement on this issue. If not, the risks of U.S. Treasury is default will resurface. Beforehand, you said the U.S. Treasuries are the most safe asset in the world. However, I think it's strange that the world's largest country faces default concerns over and over again. But please tell us your thoughts on what the risks are for the United States and what we should pay attention to from now on, without the political situations. Please give us to the investors in Japan. I think my 10 minutes is up, maybe. So now I'll give it back to Professor Eichengreen. So I think all of you have many questions to Eichengreen. So, however, first of all, please give me your answer first. Anyway, thank you very much, and thank you for listening. That's it.
ありがとうございます。Thanks very much, Nakazura-san. We are moving to the Q&A session, but before that, Barry, would you like to make any response to Nakazura-san first?
I would just elaborate a little bit what I said before, that Sir and I looked at a large sample of advanced countries and emerging markets and developing countries. We defined sustained debt consolidations in various ways, reducing the debt to GDP ratio by 20 percentage points over a period of 10 years, or a variety of other criteria of that sort. And the two robust correlates of success were sustained GDP growth and low levels of political polarization. So pick your favorite country, think about Japan in that contrast. The international comparative data suggests a relatively low level of political polarization here compared to other advanced economies, but growing GDP has been challenging.
Well, thanks both. Now, as Professor has kindly suggested, I'd like to take some questions from the floor. If you have any questions, please go ahead, and when you make a question, then indicate your name and affiliation, would you please? Is anyone? Right, Anil.
Neil Catherine from the University of Chicago. So Barry, do you spend any time wondering who's going to be the marginal buyers of dollars? One thing that seems to be true is that a lot of the purchasing of dollars over the last 2 years since COVID has been a return of a bunch of these hedge funds that hold these positions, basically trying to arbitrage small differences in futures and cash prices. And it strikes me that that's a kind of a fragile buyer, and its size is growing. I think it's above 10% now, or held in that form. So do you worry about that? And, you know, what would you do to treasury markets or anything if you were advising the debt managers in the United States?
So I haven't really worried about it until right now. You raise a good point. If it's only 10%, it's not obvious that it's going to fundamentally change the dynamics of the market. But if it continues to grow, these are our flighty, footloose investors. And I agree, there is something to worry about there.
Okay. Professor Jenny Corbett.
Jenny Corbett from Oxford University and the Australian National University. These are comments more than questions, but you might have a reaction. One is sort of in support of what you're saying, and one is perhaps slightly more worried. I'm slightly more worried than you are about another element. So the first comment is about corporate savings and the role that it plays in explaining why you might argue that Japanese debt is more sustainable than it looks. It's clear that the corporate sector is not running down its savings at the moment. There is research about that speculates that there will come a moment when this might be a tipping point that might turn into a crisis. As you know, Taka Ito and Takeo Hoshi have written about the fact that that's kind of the ceiling. When you hit that point, you may be in trouble. But some recent work I've done on corporate savings makes me think that we're some way away from that problem yet. So on the whole, I think that's another plank in explaining the sustainability of Japanese corporate debt. And I wonder whether you think that the corporate sector is something we ought to be taking into account in both places, in the US and Japan. The point, though, that is slightly more worrying is about political polarization in Japan. And I've been thinking about this, actually. It happens that I've been asked this question a few weeks ago. Why is there no sort of populism in Japan? What is it about the system here that has kept populism under control? And my reaction was, I'm not so sure there isn't potential schism in this country, but it may take a different form. But there is a public discourse about a sort of view of Japanese history that leads you to a less sanguine, less comfortable view of the current situation. It's not that we are about to see people on the street, but that actually the polarization between views of Japan is, I think, growing, but not visible publicly yet. It's buried within political parties. It's beginning to manifest itself in the popularity of certain slightly extreme candidates in certain elections recently. It may be a generational thing, but it is not totally absent here. And it's just a thought to keep in mind.
So good points both. You know, we have seen other countries in history with relatively cohesive societies and polities that have become significantly more polarized over time in response to events. We don't really know how to measure this thing we call political polarization. How much hostility do you feel toward political parties other than your own? Is that a subjective answer to that question really adequate for capturing the lack of cohesion in a political system? I don't know.
Lady.
I'm Akiko Kamesaka from Aoyama Gakuin University in Tokyo, Japan. As everyone in this room may know, today the Bank of Japan has decided to raise interest rate and also reduce the amount they're going to buy Japanese government bond. But I was wondering, what will happen if Japanese government issue a lot more Japanese government bond rather, and buy U.S. Treasury bill, Treasury security, so that we Japanese government or the Bank of Japan can an interest rate and pay only pay the borrowing cost of Japanese yen is now very low. So we can do something like carry trade, borrowing yen by very lower interest rate and invest on Japanese U.S. Treasury security and much more interest rate by investing on by higher interest rate, and that might help Japanese government deficit to reduce our government debt also. And I think many investors now do some kind of carry trade, we call carry trade, by paying lower, by borrowing yen they just pay very, very low interest rate and a lot more money from dollar. So how do you think about the kind of character?
So Ms. Nakazora kind of tried to provoke me into commenting on the BOJ's interest rate hike earlier, and I'm a firm believer that you should wait more than 3 hours after getting off an airplane before commenting on the local central bank's most recent decision. But if I understand your question, I think interest rates in Japan would have to rise very considerably before you would begin to worry about debt sustainability in the way I described it in my presentation.
Thank you. Gentleman over there, please.
Thank you very much for very interesting presentation. I'm impressed, especially because you highlight the impact of polarization. And there are some questions. I also feel that, polarization is the only issue for government debt in Japan. I feel that most Japanese people agree that the government has to spend more. That's why there is no polarization in Japan. But because of that, government debt continue to increase in Japan. I feel that. So I want to ask your opinion about this. And also, you also talk about the impact of immigration on polarization. But in Japan, facing a serious trend of aging, many economists argue that we should be opener for immigration to tackle this problem. But immigration may make a problem polarization serious. If so, that may not be good for government debt. So what do you think about this issue? Thank you.
So those are good points both on pressures for government spending. Japan is facing pressure for more defense spending, as you know. It will face more climate-related investment spending needs. But the question is whether it finances those with more current revenues or not. It might not. And when I was talking about, when I had that one slide on tension over immigration in the United States and how this goes back 150 years in the country's history, I was thinking about Japan as I was talking and wondering whether the Japanese situation may now be changing as the country opens to more immigration. I think the evidence we have from other countries is that immigration is great for the budget, that immigrants pay more into the budget than they take out, but it can create political tensions as well. And if you have me back in 20 years, I wouldn't be surprised if we had discussions about both those aspects here.
Thank you very much. By the way, I'm Hibiki Chu from Keio University. Thank you.
Is there anyone? That gentleman in this shirt.
Thank you very much for giving us the opportunity to hear your great presentation. My name is Hideaki Matsuoka. I'm from Hitotsubashi University. My question is about the implication of interest rate US. So I think that in 2004, 2005, Greenspan, FRB president, governor, called low interest rate situation in the US conundrum. I think that background is that China, other Asian countries purchase US government bond for precaution saving. But maybe situation may change. Now China is unwilling to purchase government bond. So maybe I worry about how the US interest is easy to increase. So what do you think the implications interest US?
Well, so I've been a believer for a long time that we will continue to see very gradual diversification of the international monetary and financial system away from the dollar, and that as the US economy becomes less dominant globally, the dollar will become less dominant globally as well, that new digital technologies undermine the network effects that have locked in the dollar over time. I wouldn't exaggerate the speed or extent to which that happens, but wholesale digital currencies issued by central banks around the world will eventually provide an alternative set of pipes to be used for payments that will limit the need to go through the dollar when you're selling yen and buying Peruvian pesos or whatever. If you, braver economists than I have tried to estimate the value of the exorbitant privilege the dollar enjoys as a result of being the dominant global currency. And they typically put it on the order of 10, 20, 30, 40 basis points. So if that international and reserve currency role went away entirely, it wouldn't thrust the dollar into an entirely different world, but it would make it marginally more expensive for the US Treasury to borrow.
This is not my responsibility, but I think the Japanese bank and the insurance company will buy those. So, compared to the JGB, the U.S. Treasury is attractive because there is an interest compared to JGB. So rather, we should think about who can buy JGB from now on. And that is a more serious question from my perspective. That's it.
Any question? Well, all right. So it's about time to close. Thank you very much, Professor Eichengreen, Nakazura-san. Thanks very much. Today we had a very insightful discussion. I'm sure that our discussion today is good for Japan and the United States and world as well, and for professionals as well as for the general audience who should be the key to this issue. Well, Professor Barry Eichengreen, Mana Nakazura-san, thanks very much indeed. Thanks everyone. Thank you.